What's up guys, it's Jordan Crypt from Coin Bureau, and this is my first video on the Coin Bureau podcast channel. So just a little intro into myself. I am a pro trader. I have been trading spot for over 10 years and derivatives now for 5 to 6 years. I have placed first and second in major global crypto trading tournaments, and I also run my own trading academy, as it's really my passion to guide those coming into crypto and at an intermediate skill level to not make the same mistakes that I did when I came into crypto trading with no community. As soon as I found a strong community, my crypto trading profitability changed massively for the positive. Community really is the most important thing to make sure you are being guided on the right path as opposed to doing it all on your own. So I hope we can all come together as a family and learn and trade together. So today we are speaking about crypto token fundamental analysis. If you're new to the channel, subscribe, and remember to check out the in-depth crypto trading tutorials on my personal channel. That link is in the description. Most crypto traders obsess over charts, indicators, and price action. But here's the truth. If you don't understand what you're trading, you're gambling, not trading. That's where fundamental analysis comes in. In this video, we're breaking down Crypto Token Fundamental Analysis 101. You'll learn how to evaluate tokens properly, spot red flags early, and avoid getting caught in the next hype-driven rug pull. Let's get into it. What is token fundamental analysis? Fundamental analysis is all about answering one simple question. Does this token actually deserve its valuation? In crypto, that means looking beyond price charts and asking, what problem does the project solve? Is the token actually needed? Who's building it? And most importantly, who benefits from the token existing? All of this comes down to fundamental use cases. Unlike stocks, crypto tokens aren't ownership shares. They're economic instruments inside a network, and that changes everything. Token versus project. One of the biggest mistakes traders make is confusing a project with its token. A project can be amazing, and the token can still be terrible. So, your job is not to analyze the company. It's to analyze the token's role within that ecosystem. Ask yourself, what does the token actually do? Is it required for the protocol to function? Or is it just there to raise funds? If the token has no real purpose, price appreciation relies purely on speculation, and that's a dangerous game. Next up, let's speak about token utility. Strong tokens usually fall into a few categories. Those used for fees, those required for staking or security, those needed for governance, or those that are essential for network participation. But here's the catch. Utility only matters if people are actually using the protocol. If no one is paying fees, staking, or voting, the token utility is theoretical and not real. Always look for active users, real transaction volume, and demand outside of speculation. Now let's talk about token supply, the silent killer of many trades. This is very important to understand when doing fundamental analysis, and many of you may have heard the term tokenomics. My preferred place to do this kind of analysis on all of the different aspects we're talking about today is CoinMarketCap. Start by having a look at some of your favorite tokens and try to give them a 5-star rating according to everything we're going through today. Then reevaluate them and decide whether you really should be trading or accumulating them. Also, try to compare the tokens with very strong fundamental use cases to those tokens that are just hyped, like some of the memes that have no ecosystem. In tokenomics, you need to understand max supply, circulating supply, and the emission schedule. A low circulating supply with massive unlocks coming can equal future selling pressure. High inflation with weak demand can mean price decay. A very strong sign for me of a token that has good value are those that do give a max supply, because that's a sign that they are anti-inflationary. Regarding unlocks, you need to understand who's receiving new tokens. Are they incentivized to hold or dump? And when do major unlocks happen? Unlocks can often mean short-term price downside and can actually serve as good opportunities to get into tokens if they have good fundamental use case in the long term. Ignoring token emissions is how traders get blindsided. very important is to take a hard look at who controls the supply: the team, the investors, and the incentives. That means the founders, the team allocations, venture capital investors, and advisors. The vesting schedule matters more than the marketing. You can always see the total supply held within the top 10 wallets. If this percentage is very high, the price is susceptible to manipulation. And if early investors got in at fractions of a cent, even small pumps are profit-taking opportunities for them. You want to see long vesting periods, reasonable allocations, and alignment between builders and token holders. Bad incentives lead to bad price action. Here's where most tokens fail: revenue and value accrual. Even if a protocol makes money, that doesn't mean the token captures value. You need to ask, does revenue flow to token holders? Are tokens burned? Are stakers rewarded from real fees? If all the value goes to insiders or the foundation, the token is just a speculative chip. No value accrual equals no long-term upside. So, putting it all together, before trading any token, try and run through this checklist. Does the token have real utility? Is there actual demand? Are tokenomics sustainable? Are incentives aligned? Does the token capture value? If you can't answer those questions clearly, you are trading blind. And like I said earlier, according to this checklist, try and give each token that you trade a 1 to 5 star rating. And this can help to determine how much emphasis you place on that token within your larger accumulation and portfolio diversification strategy, or your position sizing and risk limitations when it comes to futures trading. Let's look at a quick example on CoinMarketCap of the Avalanche token and project. Simply search for it on CoinMarketCap and then come to its page. Always start with your tokenomics on the top left. We can see here that Avalanche is a 4 billion market cap. The rule of thumb here is usually that micro cap tokens are 0 to 300 million, small cap tokens are 300 million to around 1 billion or 2 billion. 2 billion to 10 billion market cap tokens are mid caps, and then 10 billion and up are your large caps. Especially if you are new to futures crypto trading, you should be focusing on the mid to large cap tokens because these tokens are less volatile and less manipulated. Then very important, as I mentioned, is to check if you have a max supply or not, as this does determine whether this coin is technically inflationary or not. Also then have a look at how much of your supply is currently circulating and how much still needs to be unlocked, as these unlock events can cause temporary downside and volatility, so it's always important to be aware of when those tokens are being unlocked if you are trading them. Then always very important when doing fundamental analysis is to have a look at the website, check if there is a white paper, and then also check the socials to see how they look and if they are currently active with lots of users. CoinMarketCap does give you a profile score based on all of the fundamentals, but try to do it for yourself and not just trust this. The all-time price action chart can also give you a nice risk to reward ratio idea if you are planning on accumulating that token. We can then see here that Avalanche is traded on 398 exchanges. Also, always good to look out for if that token is currently hyped and talked about in the news. And we can see there is talk of Avalanche in the mainstream news media 1 day ago, 5 days ago, 1 week ago, and 6 days ago. We can see that there are 7 current major yield providers for staking. And then we can see the token allocation, 5% to airdrops, 10% to strategic partners, 18% to the foundation, 20% to the team, and a nice graph of the unlock progress. Then very important is to have a look at the top wallet holders and this top wallet holders distribution. Here we can see that Avalanche is looking fairly healthy compared to some of the other tokens because the top 10 wallet holders are holding 34% of the supply. If we look at other coins like Trump, we see above 90% being held by the top 10 wallets, and that is a recipe for manipulation. Then very important to come down to the about and learn all about these tokens that you are accumulating or trading. What is Avalanche? Who are the founders? And then for me, one of the most important, what makes that token unique? Also nice to understand is what tokens are similar to that token. And here you can understand the competition within that general landscape. So, fundamental analysis won't tell you when to enter, but it will tell you what's worth trading. Please let me know any questions on this content in the comments and I'll get to each and every one of them. Please also let me know any other topics you'd like me to cover and make sure you do subscribe for more. Please remember, always play from a position of power and strength, use your stop loss, and do not get wrecked.